Hi there, welcome to Kneppy Invests. One of the things I like to do is to get outside my comfort zone and to challenge my biases. And one of the biases I have right now and have had since I started investing is I am rather anti blue chip companies or companies on the ASX 100, 50, 20. I don't really like investing in those really big companies because I believe those companies aren't growing very much. So you might get a dividend, but you won't get any capital growth over the long term. And I really want to focus on those companies that have a 10 to 20 year growth trajectory, and dividends don't really concern me at all. So I'm not really investing in companies for their dividends. So I do have this bias against companies, many companies on the ASX 100, and I'm going to challenge that bias in this video, which I've broken down into two parts, and today is part one. I'm going to look at 10 companies chosen at random that are featured in the ASX 100. So these are the 100 biggest companies on the ASX. I'm going to look at the financial state of these 10 companies, look at the valuation and the sentiment. And then I'm going to see if this company is a potential buy for me. So this is not for you, this is for me. The 5 companies I'll be focusing on in this video include Computershare, Spark New Zealand, Transurban, Brambles, and Linus Corporation. Now, a few of these companies I've never looked at in the past. In fact, 3 of them, Computershare, Spark New Zealand, and Brambles, I've completely ignored since I started investing. I have looked at Transurban in the past, and Linus Corporation I did look at about 5 years ago, and that is an interesting company. In fact, I'll probably describe Linus Corporation as the most interesting company in the first lot of companies I'll be looking at in this video. What I'm going to do with all these companies is go through their financial, valuation, and sentiment. Sentiment, just be looking at a chart. Now, what I do when I start researching a company is I don't go straight to what the company does. The first thing or first step is I look at the financial history of the company. And if I don't like anything there, I just completely skip the next process, which is going to the chart. And then the next process after looking at the sentiment or the chart is to focus on what the company does. I have a feeling a lot of investors out there do it the other way around. They look at what the company does, they like what they see there, and then they look at maybe the financial state of the company, and the last thing they will do is look at the sentiment or the chart. I don't really care what a company does. If what they are doing is not succeeding over the past 10 years, there's no point moving any further in the journey. Now let's have a look at Spark New Zealand's financial state. So I'll be looking at financial year 21 numbers, comparing it to financial numbers they had in 2010 and 2011 to see if there's any growth there. What I'm looking for here is revenue growth, profit after tax growth, operating cash flow growth. If I don't see any growth in those numbers over a 10-year period, then this company automatically, for me, becomes non-investable. And the first thing I found when I looked at Spark New Zealand numbers is revenue and operating cash flow have gone backwards over the past 10 years. Net profit after tax is almost identical from 2010 at 384 million. And the net debt is about 1.3 billion. So straight away, the first thing that I noticed with Spark New Zealand is this is not the company for me because the financial state of this company has not improved over the past 10 years. As we turn our attention to the valuation metrics, price to operating cash flow, P ratio, and price to sales ratio, I prefer to look at enterprise value to operating cash flow, but I'm going to concentrate on the price to operating cash flow. And the numbers we have for Spark New Zealand do suggest that this company is growing. The P ratio right now is 22.4. And that's sort of the number you would expect for a company that is growing at a good rate. And Spark New Zealand is not doing that. And when you compare it to the historical P ratio for this company, tends to be between 14 and 18. We do see right now Spark New Zealand is a little bit expensive compared to historical values. And straight away, I know based off the valuation I see here, again, Spark New Zealand again is not an investable company for me. Now, in saying all that, and I did say again twice in that last sentence, when you do look at the 10-year weekly chart for Spark New Zealand, it actually looks really good. There has been positive sentiment within this company for a 10-year period. This is exactly the chart you want to see for a company you have held on to for the last 10 years. Probably the only thing is the share price 10 years ago in 2011 was around $1.50 and now it's $4.43. So the share price has tripled. I might prefer more than a tripling over a 10-year period, but this is really interesting. Even though the financial state of the company has not improved over a 10-year period, the share price has tripled. And that's probably suggesting that there has been multiple expansion happening with this business, not financial expansion. And I really want to invest in companies that is seeing financial expansion, not multiple expansion, which is complete reverse when you look at Spark New Zealand. Share price has gone sideways over the last few years. In fact, the share price high for Spark New Zealand was just prior to COVID-19 financial panic when the share price got down or got up to $4.70. And we did see $4.70 reached a few months ago and then it's pulled back. So maybe a potential double top. I don't think this share price of Spark New Zealand has much to run from here, simply because I do think Spark New Zealand is a little overvalued for a company that is not growing at all. Now, I'm not looking at the future of this company, so maybe you are an investor of Spark New Zealand and they do have some growth projects on hand to grow the company over the next 5 to 10 years, and that could come to fruition. But right now, based off their history, based off the fact this company has not grown over the past 10 years, and based off the fact the share price has tripled, at this point in time, I'm going to stay out of investing in Spark New Zealand. The next company I want to look at is Computershare, which is a financial administration company or a stock transfer company. I do actually use Computershare on occasion because some of the companies I've invested in use their services. Computershare, ticker code CPU, Central Processing Unit. That's the only reason I remember the ticker code of this company. I have not looked at anything in regards to Computershare over the past 12 to 13 years. Market cap of this company, $10.9 billion at a share price of $17.97. And just like Spark, what I'm going to do is look at the current financial year numbers and just compare it to financial year 2011. Revenue actually has doubled from 2011, from 1.5 billion to 3 billion. That's a good step in the right direction. I do like to see revenue growing through time. However, if we look at net profit after tax and operating cash flow, both of those metrics have gone backwards. Net profit after tax falling from 264 million to 189 million, and operating cash flow decreasing from 320 million to 307 million. So again, not what I want to see in a company I want to invest in for the long term. Now let's look at some of the valuation metrics. Price to operating cash flow at a pretty high 35.6. You probably should see that in a high growth company, and Computershare has not shown me at all, based off their financial numbers, that this company is a high growth company. Even worse, their PE ratio is at a massive 57.7. Again, you expect to see that for a rapidly growing company, and Computershare is definitely not that. Price to sales ratio 3.6. If you compare it to the historical values you typically see for Computershare, those numbers are higher than you usually do see. So again, I don't think Computershare, based off the financial state and the valuation, is a good investment right now. Of course, when I say Computershare is not an investable company, I'm talking about me and where this company fits into my investing philosophy. As we turn our attention to Computershare's weekly chart, over a 10-year period, nothing to get too excited about here. However, since the COVID-19 financial panic, share price of Computershare has moved into a nice looking uptrend. You can say there is some positive sentiment right now with Computershare. However, share price is moving towards the all-time high, which was reached back in the middle of 2018, and that all-time high was nearly $21. Right now, the share price is 18. If the share price did get down to about $9, and if it did get down to $9, I think the valuation of this company would be way more attractive. We did see $9 reach back in 2015-16, and again during the COVID-19 financial panic. At this point in time, there is some short-term sentiment, but overall, long-term share price has not quite doubled in 10 years. You would like to see any shares you own in a company more than double over a 10-year period. In fact, I would prefer any shares I have to at least doubled every 7 years, not take into account dividends. And Computershare has not done that over the past 10 years. So again, this is not really an investable company, again, for me. Next company I want to discuss is Transurban. I have looked at this company in the past, and one of the main reasons I did a little bit of research on Transurban was because there was a little bit of excitement around this company about 4 or 5 years ago, and you can definitely see that when we look at the chart. Transurban, if you don't know, own toll roads and all that sort of thing. It's fairly good moat, dependable money, you would say, unless someone invents teleportation devices, so we don't have to drive around in cars and trucks and all that sort of thing. But I think the chances of that happening is fairly remote. If you do have an invention like that, come see me and we'll make heaps and heaps of money together. Transurban's market cap, $41 billion. That's at a share price of $13.69. Revenue, $2.9 billion for the financial year 2021. It was only $1 billion in 2011. That's a triple in revenue over a 10-year period. Now we're talking. That's the sort of revenue growth I want to see over a 10-year period. Really good margins, not great margin growth over a 10-year period, but steady around 62%. Good margins there. Profit after tax, $3.3 billion. Now, this is where it gets a bit tricky because the net profit after tax has been affected by some abnormal items. So we can't really look at the net profit after tax and make assumptions on that, because if you do look at that, the P/E ratio would be really attractive right now. And you can see back in 2011, the net profit after tax was only $113 million. If we look at operating cash flow, which is my preferred sort of financial metric to look at instead of net profit after tax, operating cash flow for the year was $893 million. In 2011, it was $393 million. So we do see growth when it comes to operating cash flow. This is where it comes down to where I think Transurban loses me. It's the net debt. They have a lot of debt, and I heard a lot of people try to explain why companies like Transurban, Sydney Airport have a lot of debt, that they are sort of quasi-bond proxies, that sort of thing. And Transurban right now has net debt of $15 billion. And all I can think of is if interest rates start increasing, that's really going to affect Transurban because of the net debt. $15 billion yet again. That's a lot of debt they have on their books. Price to operating cash flow, 43.6. Historical, it's been between 12 and 18. And the price to book ratio, 3.8. And it's in the historical range. So when you do look at the price to book ratio, you can't say Transurban is overvalued right now. But the thing that really holds me back from really doing any more research on Transurban is the net debt. And I just can't get away from that thought that if interest rates increase in the future, this company will be affected by that. And it makes sense because people do say it's a bond proxy. So if you do have opinions on Transurban and why you think I might be on the wrong path by looking at the debt, because some people have tried to explain to me why that's not a problem. I just want to try to understand why the debt of $15 billion isn't a problem for Transurban. There was a period of time, as we look at the Transurban weekly chart going back to 2011, when this was an absolutely beautiful looking chart. Back in 2011, we did see a breakout in the middle of that year when the share price was around $5 or just above $5. And then the share price rose from 2011 all the way to about 2020, from $5 to a high of $16. A nice tripling in the share price during that period. And it was during around about 2014-15 is when Transurban and companies like this, including Sydney Airport, were all the rage among investors. But over the past few years, we have seen the share price of Transurban under pressure. And any times there are hints that interest rates might rise, we do see Transurban and Sydney Airport and those sort of companies under a little bit of stress, and the share price does seem to want to drop. At this point in time, I would say there's neither positive nor negative sentiment in regards to Transurban share price. Share price is just going sideways. I would like to see a bit more positive sentiment before I even think about buying into this company. However, there are some aspects, as I mentioned in the previous slide, that are holding me back from taking a position in this company. On to what I would describe as the most interesting company on the list today, and that is Linus Corporation. This is a rare earth miner. Now, the whole reason I find Lynas interesting is because 85% of the world's rare earths come from China. They do have a bit of a monopoly in this space, and Lynas is one of the, if not the only, non-China company that is mining rare earths. Even though they are called rare earths, they're not rare at all. Now, one of the reasons I started following this company about 5 or 6 years ago, I forget exactly when, and I'll be able to tell you when we look at the chart, is because rare earths were all the rage about 10 years ago. In fact, you'd be able to see the Lynas share price was much higher than it is now, and then all that hype fell off. You can see that in the share price as well. And then about 5 years ago, we did see a possible turnaround in the share price of Lynas, and that has continued over a 5-year period. I think the share price has increased 7-fold over that period. I'm just a little bit bummed out that I didn't take a position when I was planning on taking a position about 5 years ago. Lynas market cap right now is $6.3 billion at a share price of $6.95. Revenue $489 million. Now, instead of looking or comparing to 2011, they weren't in production in that year. So I went back to 2016, 5 years ago, and we have seen revenue grow from 191 million to 489 million. Capital expenditures grow from 11 million to 40 million. The company has become profitable. In 2016, they were not profitable. They lost $94 million in that year. Now they are profitable by $157 million. They had just become operating cash flow positive in 2016 by $4.1 million. Now they're operating cash flow positive by $215 million. They also have net cash, $410 million. Most of the other companies are featuring in this video, and most likely in the next video, most of these companies have net debt of well over $1 billion. So that's something going for Lynas. They actually have net cash. When you do look at some of the valuation metrics, they are or do seem a little bit high. Price to operating cash flow, 29.3, PE ratio at 40.1, and price to sales ratio at 12.9. And those numbers are a little bit higher than what you usually do see for Linus Corporation. On to by far the most interesting chart of the companies I'm featuring in this video, and that is Linus's 10-year weekly chart. And the reason I love this chart is because you can see the effects of bubbles and bubbles bursting. Back in 2010 and 11, the rare earths were all the rage. They were in vogue. Everyone loved them. This was going to be the hot sector, hot commodity for the future. Share price of Lynas got up to $26. Now, actually didn't really get up to $26 because in 2016 or 17, there was a share consolidation. And if I remember correctly, it was about 10-for-1 share consolidation. So that would mean the share price of Lynas actually got up to $2.60. So this has all been recalibrated, or the share price has been recalibrated because of that share consolidation. But you can just see the share price of Lynas got up to $26 at the height of the rare earths bubble and then fell off a cliff, falling from $26 to 25 cents. And then the turnaround happened in 2015 and 16. The share price consolidated for about a 2 to 3 year period. I'm always talking about, I like to see share price consolidating for a long period of time. And then the share price broke out in early 2018. Warren Buffett does say turnaround stories seldom turn around, but when you look at Linus' share price here, it has definitely turned around, and the share price has moved into a nice uptrend. So the sentiment right now with Linus is fairly positive when you look at the weekly chart, particularly over the past few years. In saying all that, For me personally, Lynas would not be a buy right now, even though we do see positive sentiment. We do see financial growth in profit after tax, revenue. Valuation seems a little bit lofty right now. But the thing I'd want to do with Lynas is to do a little bit more research on rare earths, do a little bit more research on the Lynas's mines, what is their mining life, that sort of thing, before I take a long-term position in this company. Final company I want to feature in this video is Brambles, our favorite cooling or pooling solutions company. And when I say pooling, I don't mean one of those things where you jump in and get cool and go for a swim. When I say pooling, I mean crates and containers, that sort of thing. Brambles do provide their financial numbers in US dollars, so I think the majority of their customers are international, overseas. Market cap of Brambles, 14.7 billion. That's at a share price of $10.19. When you look at revenue, profit after tax, and operating cash flow, there has been a little bit of growth over the past 10 years, but not a lot. Revenue has grown $700 million to $5.4 billion. Net profit after tax has grown $50 million to $526 million. And operating cash flow has grown by about $650 million to $1.6 billion. Now, it does seem like Brambles is a highly capital intensive company because they do spend a lot of money on capital expenditure, $765 million in 2011 and $1.1 billion in 2021, which means their free cash flow is only $500 million. So if I was doing any more research on Brambles, I would be focusing on their free cash flow, not their operating cash flow, because they are highly capital intensive. Net debt, $1.3 billion. They also have leases of $700 million. So you might see debt around $2 billion because some places include leases in the debt, some other places don't. Now let's focus on the valuation metrics. It does look a little bit more interesting here when you look at price, or the price to operating cash flow, which is at 7.3. Historically, Brambles is between 7 and 11. So potential value here when you look at historical valuation metrics, in particular the price to operating cash flow and the price to sales ratio. However, the PE ratio is at 21. Now that might seem a little bit high for a company that is not growing all that much, but historically Brambles' PE ratio tends to be between 20 and 30, which does surprise me for a company that doesn't grow all that much. So possible value here, and maybe we have seen the share price fall recently to more favorable levels. So let's have a look at the chart right now. And to be fair, when we look at the 10-year weekly chart for Brambles, nothing to be too excited with this chart over the past 5 years. Really, it's been going sideways, maybe trading in a range between about $9 and $13.50. So that's a 50% range. We did see the share price get to a high back in 2016 and again in 2019 at that $13.50, and then get to a low at around about $9 to $9.30 or 50 in 2017, 18, and then during the COVID-19 financial panic. There was a little bit of excitement in Brambles between 2012 and 2016. We did see the share price increase from around a $6 range to that high of $13.50. But nothing to get too excited with Brambles right now. In fact, the share price has fallen a fair bit over the past 5 weeks, falling from about $12.50 to a current share price of $10.20. And the share price does move towards that $9 range, which is their long-term low or 5-year low. Brambles could become more exciting because the valuation would be at the not historical lows, but the long-term lows. And that's the only reason I would buy into Brambles as a short-term play if the share price does get down to about $9. That's all I have for part 1 of this video. In part 2, the 5 companies I will be featuring are Sonic Healthcare, Mineral Resources, Lendlease, Vicinity Centres, and Cleanaway. I'll be honest with you, I haven't done much research on any of these 5 companies. I've started research on Sonic Healthcare, and that actually does look quite interesting. Significant growth over the past 10 years. And that might mean this could be an investable company for me. As I look further to mineral resources, I do know the share price of that company has gone through the roof because of iron ore exposure. Lend-Lease, I have looked at that company in the past on and off, not too closely, but the share price has been going lower recently. Vicinity centers, I have no idea what they do, and Cleanaway is a sort of a rubbish company, I think. I might be wrong there, but I do think they do take care of bins and that sort of thing, or maybe they're recycling. I have no idea. So I look forward to do a little bit of research on Cleanaway. So look out for that video, which should be released over the next 5 to 6 days from the 17th of October. That's all I have for this 10 stocks to buy part 1, looking at 10 companies on the ASX100, trying to challenge some of my biases to see if what I believe, that companies in the ASX100 are not the sort of companies I want to invest in because they don't really fit in my investing philosophy. If you have any questions, any thoughts, any queries, please leave it in the comment section of this video. Otherwise, I am not a financial advisor. If you do need to seek financial advice, make sure you find someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.